Today, we're taking a deep dive into the financials of a company called NSIT Enterprises. And honestly, on the surface, it looks like a company hitting some serious roadblocks. But when you start digging into the numbers, well, that's where the story gets really interesting and, frankly, a little weird.
It's like the company's financial story is telling two completely different tales at the exact same time. It's a real puzzle, right? So, our job today is to take a look at all the pieces and see if we can figure out what's actually going on.
Okay, so this is where our investigation begins. Just look at that number. The stock price has been sliced in half, from its peak just in the last year. Now, a number like that usually does one of two things. It either terrifies investors and sends them running, or it gets the real bargain hunters leaning in, very interested.
So the obvious question pops right into your head, doesn't it? Is this company just falling apart? Are we looking at some deep fundamental problem here? I mean, that's the logical conclusion to jump to. But then, just when you think you have it figured out, you see this.
And boom, here's the core conflict. I mean, look at that gap. It's huge. On one side, you've got the market. Thousands of people buying and selling, saying this stock is worth about $73. But on the other side, you've got financial models. The analyst's fair value, saying it should actually be worth closer to 200. That's not a small difference. This is the mystery we've got to unravel.
All right, so let's grab our magnifying glasses. If that fair value number is even remotely in the right ballpark, there have to be other clues, right? There must be some evidence hiding in plain sight that suggests this stock is a screaming bargain.
Okay, first tool out of the toolbox, the good old P/E ratio. You've probably heard of it. All it really is a quick gut check on how expensive a stock is compared to how much money the company makes. Simple, right? A lower P/E usually means you're getting more bang for your buck, more earnings for every dollar you invest.
And aha, here's our first big clue. Look at this. NSIT's P/E right now is way lower. We're talking more than a third lower than where it's been on average for the last 3 years. That's a pretty big deal. It's a solid piece of evidence pointing towards this stock being undervalued, at least when you compare it to itself.
But, one clue doesn't solve the case. We need more. And when we look at other key metrics, the clot thickens. It doesn't matter how you slice it. Price to sales, price to book, even price to free cash flow, they all tell the exact same story. The pattern is crystal clear. This stock is trading at a serious discount across the board compared to where it used to be. And this all circles back to that fair value we saw. It's not just some number pulled out of a hat. What it implies is something investors love to see, a margin of safety. In this case, a massive 62%. Think of it like a buffer. It's the theoretical space between what you pay and what it's supposedly worth. That's a really compelling argument that this thing could be a massive bargain.
Okay, hold on a second. Just because something is cheap doesn't mean it's a good deal, right? I mean, a car is cheap for a reason if it doesn't have an engine. So the big question is, are we looking at a great company that's just on sale, or a broken company that's priced exactly where it should be? It's time to pop the hood and do a full health check.
We're going to look at three things, three key vital signs. 1, is it actually making money effectively? 2, how much debt is it lugging around? And 3, can it pay its bills? Simple as that. This should give us a really clear picture of how strong the company is under the surface. And... right out of the gate, we hit a snag. We're looking at something called return on equity, or ROE. Basically, it tells you how good a company is at turning investors' cash into actual profits. And yeah, it's dropped. A lot. They're just not generating as much profit as they used to for every dollar invested. That's definitely a warning sign. And here comes another red flag. The debt. It's going up. We're talking a 45% jump in its debt-to-equity ratio compared to the last few years. That means more risk. Plain and simple. The plot is definitely getting more complicated now. But okay, it's not all doom and gloom on the health check. There's some good news. Its liquidity, its ability to pay its immediate bills, is actually stable. With a current ratio of 1.25, it means for every dollar it owes in the short term, it has $1.25 to cover it. So no, the lights aren't going out anytime soon.
So let's take a step back. What do we have? We have a company that looks cheap, but is also showing some worrying signs of sickness. To make any sense of this, we need to zoom out. Let's look at the bigger picture, its track record over the past few years.
And wow, what a roller coaster. Just look at these numbers. Huge jumps in 2019 and 2023. I mean, incredible years. Another great one in 2021. And then, bam, a massive crash. This isn't some slow, gentle decline. This is pure boom and bust.
Okay, now that big price drop we saw at the beginning, it's starting to make a lot more sense when you look at this. The engine of the business has pretty much stalled out. Revenue is down, and net income, that's fallen off a cliff, down almost 37%. The whole growth story has slammed into reverse.
But just when you think you've got this all figured out, the numbers throw another absolute curveball at us. Get a load of this. While sales and profits are tanking, its free cash flow has been growing at an insane rate, over 117% a year for the last 3 years. How is that even possible? Well, a company can pull levers, collect its bills faster, things like that, or maybe it was a one-off event. Whatever the reason, it's just another massive contradiction in this story.
And this chart right here, this sums up the whole dilemma perfectly. Look at the long term, 10 years out, and it's been a phenomenal investment, up almost 160%. But look at the last 3 years, and it's been an absolute train wreck, down nearly 40%. So, which one is the real story of this company?
All right, we've gone through all the evidence, the good, the bad, and the just plain confusing. We've got clues that point to a huge bargain and clues that scream company in trouble. So, let's put it all on the table for the final verdict. And here it is, the whole story in a nutshell. The argument for buying, the bull case, is pretty straightforward. It looks cheap no matter how you measure it, it's got that big margin of safety, and its long-term history is fantastic. But the argument for selling, the bear case, is just as strong. The recent stock performance has been a disaster. Growth has gone negative, and the company's health is showing some serious cracks, with profits down and debt up.
And that leaves us with the million-dollar question, doesn't it? Is Insight Enterprises a falling knife, something that just looks cheap on its way to zero, or is it a coiled spring, a great business that's been beaten down and is just waiting to rocket back up? The data gives you all the ammo you need to argue for either side, but the conclusion, well, that's one you have to reach on your own.